Hey everyone, welcome back to the AI Tech channel. Today, we're diving into a company that's been making headlines, SoundHound AI. The stock's down 55% from its all-time high. Ouch. The million-dollar question, literally, is, could buying SoundHound AI at this discount make you a millionaire? Or is this a value trap waiting to happen? That's what we're going to unpack today. Remember, in the stock market, there's no free lunch. Life-changing investments almost always come with volatility. It's the price of admission for high-risk, high-reward stocks. So buckle up. We're about to get into the nitty-gritty. SoundHound AI has been a wild ride. It's up 150% over the past year, but that 55% drop from its December peak is definitely raising eyebrows. Finding millionaire-making stocks is all about spotting the companies with the fundamental strength to bounce back and hit new highs. And that's exactly the situation we find ourselves in with SoundHound AI. The company has a compelling story, but can they turn that story into consistent revenue growth and, more importantly, profits? Let's find out. So what caused this dramatic crash? Well, SoundHound AI develops voice and sound AI for things like vehicles and drive-thrus. Back in December, the stock was trading at an insane valuation, a price-to-sales ratio of 110, that made it one of the most expensive stocks on Wall Street. These kinds of valuations are incredibly difficult to maintain. They create impossibly high expectations. Then, after the company's presentation at CES in early January, investors seemed underwhelmed. A showcase is great, but it doesn't always translate into immediate results. When a valuation is stretched that far, it doesn't take much to trigger a sell-off. The lesson here? SoundHound AI's decline is primarily because the stock got way ahead of its business fundamentals. No matter how amazing a company is, trading at over 100 times its revenue is simply unsustainable. It doesn't reflect the company's true value. Now, let's talk about the business itself. There's a lot to like. SoundHound AI is growing. They acquired Amelia in late 2024 to expand into new applications. This acquisition brings an existing customer base that's expected to boost revenue from around $85 million in 2024 to between $155 million and $175 million in 2025. Management estimates that SoundHound AI's addressable market is a massive $140 billion, which means there's huge potential for growth. But they need to keep penetrating new markets like call centers, retail, and electronic devices. Their long-term success will depend on their execution, especially since they're competing with some of the Magnificent Seven companies who also offer audio-based AI tech. The key to unlocking SoundHound AI's investment potential lies in its financials. They need to prove they can become profitable while maintaining their growth. Right now, they're burning through cash, over $75 million in the first 9 months of 2024. Until investors see a clear path to profits, the stock might struggle to maintain a high valuation. This is a critical point. So, is this stock a millionaire maker at these prices? Well, buying a stock you believe in at a lower price is always better. SoundHound AI's price-to-sales ratio has dropped to around 24, using the 2025 revenue guidance. That's much better than before, but it's still not exactly cheap. Let's compare it to SentinelOne, a growing but unprofitable cybersecurity company, which trades at around 7 times its estimated revenue. If SoundHound AI traded at the same multiple as SentinelOne, it would have to fall roughly 70% from here. Now, I'm not saying that will happen, but the wide range of valuations for similar companies highlights the risks of buying shares at this level. A potential millionaire maker is generally riskier than most stocks. Investors need to find stocks with both upside potential and valuations that leave room for massive returns. In my opinion, SoundHound AI's current valuation offers too little upside for the risks involved. Therefore, it's probably not the potential millionaire maker you're looking for. But keep an eye on them. Okay, let's switch gears and talk about another company that's seen a significant drop, The Trade Desk. In 2024, shareholders were happy. The advertising technology stock returned over 63%. But 2025 has been a different story. The stock is down nearly 36% so far this year, including a 32% drop after its earnings release on February 12th. As a result, The Trade Desk's value is now slightly lower than it was 3 years ago. However, total 2024 revenues are 54% higher than 2022. Adjusted earnings per share are 60% higher, and free cash flow is up 38%. So, are the markets significantly undervaluing this stock? Let's break down The Trade Desk's recent results. Overall, the earnings report wasn't great, especially compared to Wall Street's expectations. They beat slightly on adjusted EPS, but revenue and revenue guidance were weak. The $741 million in revenue was $18 million below expectations, and the Q1 revenue guidance of $575 million fell short by $7 million. According to the company, these disappointing results were due to self-inflicted mistakes. The rollout of its next-generation AI platform, Kokai, was slower than expected because they wanted to fine-tune the new features to customer needs. Additionally, they performed their largest reorganization in history in December. This underperformance in management execution contributed to the sell-off. It was the first time the company missed its own expectations in 33 quarters. While disappointing, it's hard to expect perfection. They've met their own expectations 97% of the time over that period. They stressed that their decisions, which affected short-term performance, were for long-term gain. But weak guidance signals that the pain might not be over yet. The trade desk's nearly flat return over the past 3 years isn't because they couldn't grow their profits or revenues. The problem is that markets are now willing to pay significantly less for each dollar of earnings. Their forward price-to-earnings ratio has dropped 46% since early 2022 and December 2024 levels of over 75x. These kinds of changes usually happen when there's a big drop in expected revenue growth, margin contraction, or management quality. Expected revenue growth is just 18% for 2025, a huge drop-off from 32% growth in 2022. Analysts expect gross and EBITDA margins to remain high, but lower than 2022 levels. There's definitely a reason for the trade desk's multiple to contract. It's also likely that the company's multiple was simply too high to begin with and needed to come down. However, given management's strong execution over several years, I don't see an issue there yet. In my opinion, the markets seem to have the trade desk priced for perfection, which is a big reason for its fall after this slip-up. However, there are still many secular trends that the trade desk is set to benefit from, including the increasing dominance of connected TV, CTV. The company sees this as its most significant growth driver going forward. The trade desk is looking to roll out its CTV operating system, Ventura, this year. But this is a crowded market, with companies like Roku and Amazon. The trade desk already has significant relationships with TV maker Vizio and Walmart, which recently purchased Vizio. It could make sense for these 3 businesses to partner up. The trade desk could integrate its Ventura platform into Vizio smart TVs. However, such a relationship could raise concerns about the trade desk's objectivity as an independent demand-side platform. Overall, the trade desk's recent fall may mark an attractive entry point for long-term growth. But near-term uncertainty could also result in shares continuing to fall over the coming months. Wall Street analysts have an average upside of 55% implied by their price targets, which suggests that the trade desk may be significantly undervalued. Keep this on your radar. Now, let's talk about a different strategy: investing in ETFs. If you're just starting out and have a limited amount of money, I suggest beginning with an exchange-traded fund, ETF. ETFs are a portfolio of investments, so they give you instant diversity instead of betting on a single company. For beginner and seasoned investors alike, I like ETFs from Vanguard. They are the king of index funds and known for low fees. ETFs include a portfolio of companies, so they have expense ratios that the investment company charges for its services. These fees are deducted daily and reflected in the performance of the ETFs. Even a seemingly low expense ratio can have a major impact on returns over time. According to the SEC, a $100,000 investment with a 4% annual return reduced by a 1% expense ratio returns around $30,000 less than an investment with a 0.25% expense ratio over 20 years. While 1% of $1,000 is only $10, as you invest more and the value grows, it can add up quickly. Fortunately, Vanguard has some of the lowest fees around, especially for its index ETFs. One of my favorite ETFs is the Vanguard Growth ETF. It has an expense ratio of just 0.04%, compared to an average of 0.94% for similar growth funds. This means investors get to keep nearly all the returns. The Vanguard Growth ETF focuses on large-cap growth stocks, especially in the tech sector. It tracks the CRSP US Large Cap Growth Index, which is essentially the growth-oriented half of the S&P 500. Nearly 60% of the ETF's holdings are tech stocks, while another nearly 20% are consumer discretionary. However, some tech-oriented companies get pushed into the consumer discretionary category, such as Amazon and Tesla. Overall, the Vanguard Growth ETF gives investors a heavy concentration of some of the leading technology companies in the world. Its top 10 holdings include Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta Platforms, Tesla, Eli Lilly, Broadcom, and Visa. The Vanguard Growth ETF has also been a strong performer over the years, outperforming the S&P 500 in the long term. The ETF's average annual return is 16.2% over the past decade, compared to 13.8% for the S&P 500. On a cumulative basis, the ETF is up 346.9% compared to 263% for the S&P 500. For a $1,000 investment, that means you would reach $4,469 at the end of 10 years. The returns have been even stronger recently. The ETF has generated an average annual return of 18.1% over the past 5 years and 32.3% over the past year. That compares to an average annual return of 15.2% for the S&P 500 over the past 5 years and 26.4% over the past year. Investing $1,000 and leaving it there for the next 10 or 20 years will likely increase your investment, but it won't make you wealthy. The key is to invest in the ETF on a consistent basis. Setting aside money to invest each month or with each paycheck is one of the best ways to accumulate long-term wealth. This strategy is called dollar-cost averaging, where investors buy an investment, such as an ETF, on a regular basis, whether the investment is up or down in price. Over the long term, this is a strong proven strategy that helps investors achieve great wealth. For example, if you invested $1,000 and added $500 a month into an ETF that generates a 10% average annual return, it would be worth over $1 million in 30 years. Bump that additional investment to $1,000 per month, and it would be worth over $1 million in 23 years. Note that actual results could differ due to market fluctuations, but this gives you a good sense of the type of returns you could see. The tech sector has created plenty of millionaires over the years, but it has also disappointed many investors who chase the wrong stocks. To find the next millionaire-maker tech stock, investors should seek out companies with unique advantages, high growth rates, and sticky business models. I believe 3 high-growth tech stocks check all the right boxes: SoundHound AI, SentinelOne, and Cloudflare. Let's see why this trio might be well poised to deliver multi-bagger gains over the next few years. Yes, we're back to SoundHound AI. They develop voice and audio recognition tools. Their namesake app helps users identify songs, while its Houndify platform lets companies develop their own customized voice recognition apps. Automakers like Hyundai, smart TV makers like Vizio, and fast food chains like Church's Chicken all use Houndify to create their own speech recognition tools that aren't tethered to a bigger data mining tech company. SoundHound's revenue grew 47% in both 2022 and 2023, and it anticipates 79% to 85% growth in 2024 and 86% to 110% growth from that midpoint estimate in 2025. This acceleration will be driven by both its organic growth and its recent acquisitions, including SYNQ3, Allset, and Amelia. They're also working with Perplexity to upgrade their large language models and integrate more voice recognition tools into NVIDIA's Drive automotive platform. SoundHound isn't profitable yet, and its stock isn't cheap at 14 times next year's sales. But this hypergrowth company could deliver impressive gains as the generative AI market expands. That might be why NVIDIA owns a minor stake in this little company. It's something to think about. SentinelOne is a cybersecurity company aiming to replace all human analysts with AI-powered algorithms. They claim that approach is faster, more efficient, and less prone to errors. Its Singularity Extended Detection and Response (XDR) platform runs on a mix of on-site appliances and cloud-based services. SentinelOne's AI-driven approach impressed a lot of companies. Its revenue more than doubled in fiscal 2021, 2022, and 2023. Its dollar-based net revenue retention rate also rose from 117% to 132%. Its revenue grew another 47% in fiscal 2024, but its dollar-based net revenue retention rate slipped to 114% as its growth in larger customers decelerated. For fiscal 2025, they expect revenue to rise 31%. That slowdown spooked investors and drove its stock below its IPO price. But after that decline, SentinelOne looks more reasonably valued at 8 times next year's sales. It's nowhere close to breaking even yet, but it could grow much larger as more companies turn toward AI-powered automated cybersecurity solutions. It might also be a tempting target. Cloudflare operates a massive content delivery network, CDN, that accelerates the delivery of digital content for websites and apps. It also provides cybersecurity services that shield its customers from DDoS attacks, bot-based threats, and other malicious activities. Cloudflare's revenue rose 52% in 2022 and 32% in 2023. Analysts expect its revenue to rise another 27% in 2024 and 25% in 2025. Unlike SoundHound AI and SentinelOne, Cloudflare is profitable on a non-GAAP basis. But it still isn't profitable under generally accepted accounting principles, GAAP. Cloudflare stock trades at a steep 13 times next year's sales, but its robust growth rates, sticky recurring revenue, and expanding ecosystem make it a compelling investment. Its CEO, Matthew Prince, is highly regarded, and the company continues to innovate in the cybersecurity and web performance spaces. Cloudflare is a solid long-term bet on the growth of the internet. So, there you have it, a deep dive into SoundHound AI, the trade desk, the Vanguard Growth ETF, and 3 potentially millionaire-making tech stocks. Remember, investing always involves risk, and no stock is guaranteed to make you a millionaire. But by doing your research, understanding the fundamentals, and diversifying your portfolio, you can significantly increase your chances of success. What do you think? Is SoundHound AI a buy after this dip? Are you bullish on the trade desk? Let me know in the comments below. And don't forget to like and subscribe for more AI and tech investing insights. Thanks for watching.